Welcome back to The Explainer. Today, we are cracking open one of the most powerful tools in the entire world of finance, discounted cash flow. If you've ever wondered how the pros figure out what a company is actually worth, stick around, because you're in exactly the right place.
Okay, let's just get right into it with a big question. Imagine you find a company. The story is exciting, the products look amazing, but before you put your own money on the line, how do you cut through all the noise, all the hype, and figure out what that business is really worth?
And answering that question is pretty much what separates a wild guess from a truly smart investment. So today, we're going to unlock the very method that professional analysts, and yes, even legendary investors, use to find a company's true fundamental value.
So what is this powerful tool? Well, at its heart, discounted cash flow, or DCF for short, is actually a beautifully simple idea. It's a way of looking at a business and saying, hey, its value today is just all the cash it's going to make in the future added up. It's all about valuing a company based on its raw ability to generate cold, hard cash.
This right here, this is the single most important idea behind all of DCF. It's called the time value of money. Think about it. A rupee in your hand right now is way more valuable than the promise of a rupee a year from now. Why? Because you could invest that rupee today and earn a return on it. The entire DCF model is built on this one simple, powerful truth.
So why do so many financial pros, from Wall Street to Dalal Street, lean on this method so heavily? What exactly gives DCF so much power?
Well, for starters, this isn't just some theory from a dusty old textbook. Look at this. Investment bankers are using it to price those massive billion-dollar mergers you read about. Equity analysts are relying on it to set the stock price targets you see on the news. And yeah, even venture capitalists are using it to try and figure out the value of the next big thing. It is a workhorse for huge financial decisions.
And they all use it for one main reason: to hunt down a company's intrinsic value. That's its true underlying worth, totally separate from the day-to-day mood swings of the stock market. Focusing on that helps investors avoid the classic mistake of overpaying, and it lets you compare completely different companies on a real apples-to-apples basis. But, and this is a really important but, DCF isn't a magic wand. It works best when you can actually predict the future with some confidence. So for a stable, established company with a long track record, DCF is an absolute beast. But for, say, a brand new startup with zero revenue, or a company in a crazy, unpredictable industry, well, the model gets a lot less reliable because your whole forecast is built on a lot more guesswork.
All right, so we've covered the what and the why. Now for the fun part. Let's pop the hood and see how this thing actually works. Don't worry, we're just going to look at this simplified blueprint, focusing on the logic, not the complicated math. The whole thing really boils down to 5 logical steps. First, you forecast. You try to predict how much free cash flow, that's the cash left over after running the business, the company is going to make for the next, say, 5 or 10 years. Second, you discount. Because remember, future money isn't worth as much today, so you apply a discount rate to adjust for both time and risk. Third, you find the present value, which is just calculating what each of those future cash flows is worth in today's money. Fourth, you estimate a terminal value, because a great company doesn't just stop existing after 10 years. This is a guess at its value for all the years after that. And finally, you just add it all up to get the company's total value. I know, that might sound like a lot of moving parts, but the concept itself is really straightforward. Let's make it crystal clear and walk through a super simple example together.
Okay, so let's imagine we're looking at a company, and we predict it's going to generate a nice and steady 100 crore rupees in free cash flow every single year for the next 5 years. Great! Step 1, our forecast is done.
Now for steps 2 and 3, the discounting part. We'll use a 10% discount rate to account for that whole time and risk thing. So applying that rate means the 100 crores the company earns next year, well, it isn't worth 100 crores to us today. It's worth more like 91 crores. And the 100 crores that earns 5 years from now, that's worth even less today, only about 62 crores. We just do that for every single year, pulling all that future money back into the present.
So after we've done all that projecting and all that discounting, and we've added everything up, what do we actually have? What's the final verdict this whole process delivers?
And this is the payoff. That final number you get is your best estimate of the company's intrinsic value. Then you can compare that number directly to its current price on the stock market. If your DCF value is higher, the stock could be undervalued, a potential bargain. If your value is lower, well, the stock might just be overvalued.
Look, if you only remember one thing today, let it be this. DCF is all about taking a company's future cash flows, bringing them back to what they're worth today, and using that to find its true underlying value. That's it.
Now, I bet some of you are asking, hey, wait a second, where did that 10% discount rate just come from? And you know what? That is a fantastic and absolutely critical question. Choosing the right discount rate is a huge part of this, so in our very next explainer, we're going to dive deep into the most common one, the weighted average cost of capital, or WACC.
But before you go, we want to put all this into practice, and we want your help. Let us know down in the comments, which real-world company should we try to analyze using a DCF model in a future explainer? We can't wait to see what you come up with. Thanks for watching.